Hi, everyone. I'm sitting here today with one of my partners in this industry. And why I say that is that you have to have the tools in your toolbox in order to be in the real estate. So I have joined with Tammy and Sean Frith with the Frith team at CrossCountry Mortgage. And why is that important? Well, it is important to have people who have knowledge about what's going on. And specifically, we're talking about condo industry, short-term rental industry today to see how we can help you make your dreams come true of having home ownership there as a second home or as a rental income. So Tammy, tell me, what does it mean to be non-QM?
Great question, Marsha, because if you had asked me 3 years ago, I couldn't give you that answer. So Sean and I moved to the Panhandle, will be 3 years in December, and we learned very quickly that we live in a resort area in some parts of the Panhandle, meaning condos, condotels, second home, and investment property. So we had to get very educated to be able to serve all agents and help them grow their business. So the definition of that, these are loans that does not meet traditional guidelines.
Okay? And so what you mean by traditional, FHA, VA, regular conventional
That
loans?
is correct. They don't meet traditional guidelines. So CrossCountry Mortgage is the #1 non-QM lender in the country, and they house these loans. So it could be as easy as a conventional loan with a DTI of a 55, where Fannie and Freddie.
Okay, so DTI, debt to income ratio. Okay.
With Fannie
Just
and
making
Freddie
sure everybody understands.
is a 50%, but on
Okay.
our in-house, we'll go to 55.
Okay.
Okay. Second homes, and what we've seen the last 2 years, and Sean, you can comment, is the bucket of loans on a conventional side has been priced out of the market, meaning interest rates have been 8 to 9% for most of these products. So we're able to do them in-house with a much less interest rate as well.
Okay, so let me understand. So the second home industry, when you get into that, the interest rate has been so high that they can't qualify their payments and having to pay for the fees, because obviously owning in an association comes with fees, that it gets too expensive.
It doesn't cash flow.
It doesn't cash flow. So this gives them a way and an opportunity to own an investment property or a second home without having to go the conventional way.
That's correct, because we do them in-house. Go
And
ahead.
there's also the non-QM market is an emerging market, and one of the reasons that it's come so popular is because it's a very practical, low documentation, much easier for the investors to do loans that are, and we'll get into the different types of loans, but half the documentation, much simpler. And we all know that in the world of finance, when you're looking at tax returns, it can devastate you in your ability to purchase, whereas some of these loan types are very practical and can get around some of the tax returns issues that people have.
And they're TRID-free, meaning we don't have to meet a redisclosure period, a time frame. These are loans outside of TRID.
Okay.
They don't have the same
so TRID,
compliance.
if you guys are just wondering, it's traditional. When we go to closing, it has to follow a certain framework. You get to with the title company, has to balance, do all these things, has to meet the federal guidelines. That's what we're talking about when we're talking about TRID and traditional. So because these are housed in-house, that means you don't sell the loan, correct?
That's correct.
So your servicer for the loan will not change unless you were to sell or refinance.
That's correct. And what I will say on the non-QMs is you may not think that you qualify. For example, I had a contract I got in a few days ago, and looking at the gentleman's tax returns, he did not qualify. I flipped him over to a non-QM loan, DSCR, where we do not verify income. We only verify income on the property that he's buying. I needed 2 docs, and the loan was approved, subject to an appraisal.
Well, that's different too, isn't it? With the non-QM, the appraisal process is a little bit different. And I want to ask Sean about this new program that you guys are using. It's called Air DNA.
Right.
And if I understand it correctly, it gives a better projections and precise on what the rental income can be for any particular property based on this program that you use?
Right. So, because we do lots of programs that don't require employment and we're using the income on the property, our company will allow us to validate as a backup plan the income on the property through third-party websites like AirDNA, because AirDNA is an actual number and it's scrubbing and it gets its data from real numbers. We can look at the property before we get started to make an assessment if we think that using a certain percentage of what AirDNA shows will allow us to validate the property income in the end. So we can usually, as a step number one, is just use the appraisal, and whatever the annual number is divided by 12, as long as that equals to or is greater than the full mortgage payment of principal and interest, tax and insurance, homeowners association, or we can use AirDNA to do 80% of the number it gives us. And that is very helpful because as somebody's looking at a property, we can do an analysis and give them feedback if it works without having to count on the appraisal.
Okay. So for me as a real estate agent, how is that beneficial to me? How can I use that to maybe get more business or get people feel more comfortable? How could I use this Air DNA to like bring another resource to my clients?
Okay, so one of the reasons is because the product itself does not require any employment or income. So if you have somebody that is got a messy tax return and they've got very little net income on there, you just take that and throw it away. So it's an easy calculation that we can do in 5 minutes while you're on the way to the property. We can send you a text and analyze it and say, that one works, because we know the bedroom, bathroom count, and we've run the validator, and we can say, it doesn't matter what the appraiser gives us, we already can trump the appraiser and we validate on that property.
And what it does, it saves you time because you and your client know in advance if this property is going to work using DSCR or not, versus showing them 10 properties, waiting on the appraisal to come in to see what the 1007 rental analysis is. And that is what makes us different, because CrossCountry allows us to validate that up front.
And see, this is why you have to have multiple tools in your toolbox. As we're sitting here today, every time I get together with Tammy and Sean, I learn something new, something that is important for me, not only as the real estate agent, but also me as a consumer, because we are looking into buying rentals and having some second income that comes from alternative sources. So it's such a good thing to be with somebody that knows what needs to be done or knows people to get the job done. So I really appreciate you guys taking some time today to spend with me. Again, it's Tammy and Sean Frith with the Frith team at CrossCountry Mortgage, and I'm Marsha Babe. And yes, that's right, I'm the Babe of the Babe Group at ERA American Real Estate.